Well, the markets certainly liked the weekend news flow. U.S. and China try to walk back the meat of the trade war, and traders certainly are applauding as they do. But are we through the worst, and are we on the other side? This is the key question now in front of markets. And without any ado, we're going to jump right in and take a look at what comes next. There is a bevy of macro event risk this week to inform precisely that question. And we'll get right into it here and see if, in fact, we can finally put a pin in this trade war and say, well, everything is back to normal and we are going down a better path. Here's a quick look at the performance across the major markets last week. We can see equities stalled. The bond market saw a slight increase in yields. The U.S. dollar strengthened a touch against that backdrop, up about 0.4% against the euro, 0.2% against the yen. Crude oil had a nice little pop around all manner of cross currents, as ever, walking to the beat of its own drum. Gold prices bounced a bit, but of course that story has significantly changed now. At the open of this week, a lot of these moves looking very different, and of course the standstill in stocks in particular in a very different sort of setting here. And this helpful chart from the Wall Street Journal just helps to really highlight the dynamics of what's occurred. So we have a sharp spike right at the weekly trading open, and it follows news that after 2 days of talks in Geneva, Switzerland, Treasury Secretary Scott Bessent, U.S. Trade Representative Jameson Greer, and their counterparts from China reached some sort of epic breakthrough in negotiations. Apparently, all that was needed was for people to sit across the table from each other, for there to be a sudden epiphany of understanding. The president commenting on Truth Social over the weekend that this has been a total reset, quote unquote, of relations with China. So what has actually occurred? Well, we have a pause of 90 days on tariffs above 10%. with a carve out for those tariffs that target a sort of more punitive line around the export of fentanyl precursor chemicals from China, and a desire from Washington for China to battle that more vigorously. So we go down on net from 145% levy rates U.S. against China down to 30. That's a baseline of 10, the same one that was baked into the trade deal with the UK last week, and the same one that was announced as the new floor on quote-unquote Liberation Day. And there's that additional 20% of carve-out tariffs. For China, we come down from 125% down to that 10. So obviously much lower tariffs than were there when the trading session closed on Friday, and obviously the markets love to see it. In addition to these dramatic moves in stocks, which end up giving us a gain of 3.3% on the S&P, 4.07%, almost 4.1% on the NASDAQ, 3.6% on the Russell. We get a dramatic shift lower in the bonds across maturities, down 0.25% on the 2-year, but down 0.6% on the 10-year, and down almost 0.75% on the 30-year. The gold picture much weaker. That's down 2.7% today. Dollar up about a percentage point against an average of its major counterparts. So a broad-based unclenching around the markets. But Looking at the S&P 500 here as a kind of bellwether asset for risk sentiment, one does begin to ask, why stop here? This is a very interesting point here, as a matter of fact, for the S&P 500. We can see here that we establish a kind of consolidation range from early December into about the middle of February, and we test the bottom of this range continuously. This is where the markets are sort of waiting to see, as it were, what the new administration will do. There's obviously a blistering rally into this range, but as the year begins to wind down and we begin to turn in the direction of what the new administration might do, and of course the end of year dynamics more broadly, the markets settle into this range, and it is mid-February when they start to roll over, and going into March when they really break the range and establish that what began here was not just another pullback in the range, like this, say, but rather a more concerted breakdown. We, of course, bounce off the lows just above 5,500 there that we find in mid-March and consolidate right up until we get into Liberation Day, where we get our hair on fire moment here as the markets contemplate the possibility that the U.S. is looking to extricate itself from its role as the global reserve currency, as the risk-free asset of choice, and what that might mean more generally for a financial system that is absolutely dependent on those two things existing and holding. And so we've come all the way back to erase that scare, and with this pop today, we come back to the starting line of the bearish breakdown as a whole. The question now is, of course, why do we stop right here? Why don't we keep going? And what does it mean to have come back and stopped at exactly this spot? So you come back to the realization that if the markets were afraid of tariffs as a general concept, then this sell-off would not have started here. It would have started here, back in November, when the outcome of the election became certain. Because, of course, at the time, candidate Trump had spoken extensively about tariffs, and anybody with ears and eyes over the preceding months might have known that this was coming in some shape or form. Instead, the markets rallied. They rallied because they reasoned that the tariff story would be about as flimsy as it was during the first Trump administration, where there were tariffs, and really they were just onboarding tactics for trade negotiations. The transformation of NAFTA into a nearly identical USMCA that ultimately just gave us freer trade by expanding the agreement and didn't actually do much else. That looked to be the framework. Meanwhile, people looked ahead to tax cuts, they looked ahead to deregulation, all of which was seen as probably going to juice up growth, at least in the near term. So the tariffs were not a source of fear when they were obviously going to happen to some extent. They became a source of fear here. Well, what changed here was the tone of the economic data, which signaled that the rollout of the tariffs at that point with Canada and Mexico, as it presented itself, was enough of a concern for businesses and consumers that they stopped and looked around and said, you know what? We're going to wind back spending. We're going to wind back investment. We're going to wait until the dust settles. Because for now, the fog is too thick. And that was a very significant dampener on economic activity. This was, again, before any of the reciprocal tariffs, before anything that we now, in the wake of this dramatic rally off April lows, can say has been digested, priced in, and perhaps moved on from. We'll see in 90 days if that part holds. But all of that aside, we are back to the point where the markets decided that what's coming is some sort of an economic downturn because uncertainty has put the brakes on spending. We can see from the latest survey data here released over the past several weeks exactly what is at work. These are the numbers that kick us off. We see that after nearly 6 months of very strong U.S. growth, in fact, by the end of last year, the strongest in almost 2 years. In fact, a little bit over if we look at the sort of totality of what's going on here. We get this sharp deceleration just as the year begins. And we can see, of course, as ever in the logic of PMIs, where 50 is neutral, above 50 is growth, and below 50 is contraction, that we come down from these higher levels of growth. The higher you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We find that growth on this composite index that subsumes services and manufacturing, we go from these heady levels to essentially standstill. And in the most recent data, even further that way. In fact, we get the weakest growth in 17 months. It's a similar situation for the ISM survey, a different view of similar data. And here you get slightly stronger services than you do in the S&P Global version, but you get slightly weaker manufacturing than you do in that version. But when you look at what it all boils down to, it's a coordinated slowdown in both services and manufacturing since the beginning of the year, and a relative netting out, again, just a hair above the 50 line, once you consider that services is a bigger part of whatever average you might construct here than manufacturing, because it's just a bigger part of the economy. So you get a sense that you're biased a little bit north of 50, but only just. And so either way you slice it, you're back to effectively standstill as far as this survey data is concerned. Now, you seem to get confirmation of a slowdown in the latest set of first quarter GDP numbers, but of course, as we've discussed here in detail and as has been covered extensively elsewhere, there is a massive distortion here from the tariffs. Even the Fed name checks these distortions in last week's policy announcement. So perhaps once those distortions are out of the way, then everything is okay. And indeed, we do have a historic walking back of risk to the economy with this U.S.-China de-escalation. But maybe not so fast. Here's the breakdown of GDP, and indeed we find that we have dramatic distortions in the data. The negative number on overall GDP almost certainly impacted dramatically by this near 40% surge in imports. Of course, as people look ahead to tariffs and front load as much as they can before those tariffs hit. Again, this is the first quarter. This is through March. The reciprocal tariffs are not a thing at this point. This is just the markets and businesses knowing that the administration wants to do tariffs and trying to anticipate that by buying as much as they can offshore and getting it into inventories before tariff rates go up. So, of course, you get this surge in inventories, which are a part of this investment component here. You get a surge in imports, which dramatically undermines the overall GDP numbers. If you stripped this out and you stripped this out, you'd be left with a much more normal picture. But the real bit here that bears paying attention to isn't any of this at all. Take away all of this, and this component here, consumption, is the weakest it has been since back here, the second quarter of 2023. So we're looking at the weakest consumption levels, or the weakest consumption growth, in close to 2 years. And it is in fact this part that matters, because consumption makes up 68.5% of GDP in this latest data set, as it tends to do. It tends to oscillate somewhere around the 70% mark. Whereas the external sector only amounts to, once you net out exports and imports, something on the order of 4.5–5% of the overall picture. So the question beyond the trade deal here is what happens next, and whether the real reason that the markets were concerned to begin with before the escalation, which you can see right here, was the growth concern, and whether that growth concern has been undone by this apparent walking back of the worst of the trade war chaos. And on that score, we have ample data this week to try to make a decision, starting, of course, with US CPI figures. Here, we are looking for standstill. The core rate expected to remain unchanged at 2.8%. That's excluding food and energy. The headline expected to remain unchanged, likewise at 2.4%. But it's really the makeup of these numbers that matters most. The market is back to pricing Fed policy exactly as Fed officials envisioned it in December and in March. 50 basis points in cuts this year, 50 basis points in cuts next year. So whatever panicky reason there was for the markets to think the Fed would go faster, they've been unwound. And the Fed has very clearly said, look, we don't know which way to go here. We heard from the Fed just last week, and they told us, look, we don't know which part of the mandate to prioritize. Now, if the tariffs have in fact been put back into a box to a large extent, despite the fact, of course, that if the floor really is 10%, and before these latest hikes, the average U.S. tariff was 2%, then the price of imports for consumers still have gone up 5-fold. But perhaps that is digestible. We'll have to see. Nevertheless, consumers still face precisely the same calculus. And so if we have a situation here where goods inflation, which we can see here is barely an afterthought in the most recent numbers, if that starts to increase in this April data at the same time as the service sector, this big bit right here, starts to see cooling inflation continue. In fact, we ended up in the most recent data in March with the slowest service sector inflation that we have seen since back in December of 2021, telling us that the pull from demand is weakening. And of course, we just saw with these PMI numbers and these, the service sector is where demand has lived in the U.S. If service side inflation is cooling, that tells you that the pull from demand there is unraveling. And if at the same time that gives us a pop in goods inflation around this 5-fold increase in duties, again, best case scenario, well then consumers aren't going to be very happy. And they're probably not going to be enthusiastic about rebuilding consumption from here to levels more familiar with where growth was much more robust. Later in the week, we get U.S. retail sales data, expectation that retail sales stalled in April after this 1.5% surge in March. Again, consumers seemingly front-running the tariffs as well, and that now expected to have run its course. The year-on-year rate expected to come down to 1.1%. If we consider sort of where that puts us in the relative history, it is hardly encouraging. This would be the slowest that we've seen for retail sales growth since January of 2024 in year-on-year terms, and indeed one of the weakest numbers that we'd seen since before COVID. In fact, the January of 2024 number was only 0.3%, and that was something of an anomaly. To get anywhere like this 1.1% expectation, we have to go all the way back to mid-2023, and it'd be an anomaly then. As a matter of fact, you'd have to come back to pre-COVID retail sales growth to get somewhere in the vicinity of what this would look like. And so, with that in mind, you have yet another window here for the consumers to show you just how willing they are to buy the optimism. And of course, at the end of the week, we get an even clearer picture, an update from the University of Michigan on their very closely watched consumer confidence survey. Obviously, all of this talk of tariffs has absolutely cratered confidence, and that's as we've seen a sharp rise in consumer inflation expectations. So a surge here to 6.5% inflation, higher than at the peak in 2021 going into 2022. So consumers are plainly unhappy here. And if none of what's happened here changes that basic baseline, and indeed, U.S. economic data has tended to disappoint relative to forecasts, as we see on this Citigroup index still hovering below zero. Well, then this component to overall growth is hardly fixed. And this is the one that matters. All of this noise notwithstanding. So if in fact all of this back and forth has failed to give consumers the kind of confidence to bring them back in force, well then all of this inventory buildup is for naught because there's not anybody to sell it to. And perhaps the situation is even worse than it was before, because whereas businesses did not have huge fixed inventory costs before this episode, if consumers end up not buying this inventory at the speed that businesses might hope, or even at the pace that was there before, again, looking at this year-on-year retail sales line here, we can see that from early 2024, the pace has been slowly creeping higher until this most recent drop-off. So if we get then the sense that consumers are not any happier, that demand is not any stronger, and that the march toward recession continues, well then this becomes a very auspicious place to stop indeed. Because this becomes the place where the handoff from the hair on fire portion of the story back to the recession portion occurs right in the spot where you'd expect it, not in a way that is favorable for continuation of this risk on build. That is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go from there. I'm on with Chris for Futures Power Hour, Mondays and Fridays. On with Victor Jones for the Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.